China has usurped gold, classifying it as the only liquid zero counterparty risk, high quality liquid asset. And that is why global central banks, alongside sovereigns, Western facing institutional investors, and borrowers, are being onboarded at unprecedented rate into SGE physical backed exchanges.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money. Now, Live from the Vault is the show that goes beyond the headlines to uncover the truth about the precious metals industry. And joining us today is Kinesis' very own world-renowned whistleblower and precious metals industry expert, Mr. Andrew Maguire. And this week, we'll be answering again some questions from the Live from the Vault community. So, keep those questions coming in, by the way. If you haven't asked a question, you want to ask Andrew a question, all you got to do is look at the link below. We put it in the description, and you can record it in your own voice. You never know. Your question just may be chosen for Andrew to answer right here on Live from the Vault. So let's head over to the UK and talking gold with Andrew Maguire. All right, Andrew, it couldn't be a better time for you to bring us all up to date on what you're expecting following the extreme gold and silver volatility that followed our last market update recorded on the 15th, just 2 weeks ago. Now, I know that you've been really keen, to really dissect the various LBMA and COMEX physical market actors' footprints and where that places the physical support levels here. Now, spoiler alert, there are no changes to your bullish end-of-year gold price targets. And with that said, over to you, Andrew.
Yeah, thanks, Shane. Great to be with everyone again. Yeah, keep those questions coming. I think, obviously, the bulk of the questions were about volatility. What's going on? And that is what we're going to look at. So following what is really extreme volatility, which followed our last episode on the 15th, and we're recording this on the 29th, so Wednesday 29th, we've got FOMC later. So, expect the usual kind of stuff to go on, but we've got what we're going to do is connect all the short-term action with all of the interconnected reasons gold and silver were able to be put in the crosshairs for an officially targeted speculative long stop rinse, i.e. going after the naked longs from the COMEX. And that essentially this move took out most of the October move higher, but in the process of shaking out the speculators, and we always said these speculators are the problem, but after shaking them down, what that's done is there's been a wealth transfer of gold and silver from weak hands into strong at a higher physically supported rally point. Now, while the 10% top to bottom correction has cleaned out all the froth and has now wrong-footed these same leveraged actors to flip from naked long and chasing it up to naked short and chasing it down. This naked short sell gold and silver is occurring. It's being taken up by very strong physically held hands, and they haven't gone away. And it also did not go unnoticed, though. We're going to connect all the bits here. That the trigger point to target these ballooning speculative positions was timed with Trump's China posturing. Now, it's all connected in combination with very fresh weaponized geopolitical energy sanctions. That's primarily to put pressure on the core Russia, India, BRICS fulcrum, the RICS portion of the BRICS fulcrum. Trump was also attempting to push back against the gold-rich BRICS alliance. Now, what is visible is, alongside the weaponizing of energy geopolitical sanctions, billions of dollars of COMEX gold and silver were created and sold into the market to cap the gold price from breaking above 4,400. risking, because really 4,400, I mean, that was risking forcing the Fed to buy back upcoming end of month borrowed Bank of International Settlements gold bets at over $600 higher than last month's 4 tons being squared $409 at a loss. Now, the Fed is the only central bank still fighting a rising gold price, and it's completely mishandled the US Treasury's gold positions. And with 30 tons still to be bought back, plus billions of dollars of the Office of the Comptroller bets, the OCC bets that are visible to anyone, these bets directly relate to US Treasury rehypothecations, double ownerships, and which so really what it's potentially doing is facing a default into this incredible physically supported rally. Obviously, a portion of that was not the physical buyers. Now, US Treasury gold positions, so basically, still have to be 30 tons, still has to be bought back, plus the billions of OCC bets that already relate to these rehypothecations. So that's a real issue. Now, while any other trader would be margin called by their broker and forced to cash settle such enormous unhedged losses, it required, and this is why we know it's official, it required the US Treasury to step in to temporarily staunch the massive de-dollarisation flows evident in the gold-dollar foreign exchange cross, i.e. selling dollars to buy gold in the FX crosses. Don't forget, it's a currency. And they would have, so what they did was could have easily weighed up the scope of such a pushback, but as temporary though, and directly limited, they would know it's directly limited to how many COMEX speculators could be rinsed out before physical support equilibrium could have been reached. And that equated to a 10% correction. Now, we'll look at that in the charts in a minute. This is just healthy stuff. However, as we'll look at shortly, this capping is 100% equated to, is reliant, 100% reliant on how much dwindling siloed COMEX leveraged liquidity, i.e. what you can create, leverage you can create in the COMEX, how much of that can be flushed out before it exposed the house to delivery obligations they could not short cover into. Now, this liquidity really clashed up against an upsurge of central bank sovereign and institutional physical market liquidity, and the pushback met a wall of buyers. So you've got unleveraged, you've got paper gold being created out of thin air, and you've got central bank sovereign buyers saying, give me the physical. Now, there'll be more on this, but we'll alter this, how this is going to play out, we're going to look at shortly. But to first answer the short-term questions, which we had many of, let's drill down into the current footprints, following our last episode on the 15th of October. So we'll start with a look at where we stand following what looks like the exhaustion stage of this officially orchestrated COMEX 3-week top-to-bottom pushback against an out-of-control spec-assisted China-orchestrated BRICS plus dollar-to-gold de-dollarisation escalation. What was happening. Part of that was being powered by the speculators. That's the part they targeted. So let's have a look at the charts quickly. In fact, stepping back to where we were just 2 short weeks ago, and that was right here. In fact, I'll drill down into the smaller chart. What we're going to do is put into context where we are now, and it kind of puts the current COMEX-driven volatility into perspective. Now, the speculator-driven rally into the all-time highs, right here, encountered the second of 2 margin increases. Now, if you remember, we discussed the very odd situation long before we were suspecting there'd be some margin increases, but we were puzzling as to why they hadn't happened. Now, bear in mind, there'd been no margin increases since November 2024. And the first one came in on the 9th of October, and we drew attention to it. This is where we were recording exactly 2 weeks ago. And we drew attention to it, basically questioning why it had taken 11 months and a $1,550 rise in the gold price from $2,500 to $4,050 for the house to increase margin borrowing costs. And this is when they increased them at around $4,050. These are the future charts. And we referred to this illustrating that was basically added a 7% bump. So you could still borrow COMEX gold at a 95.75% leverage basis. Used to be 96%, so barely difference. So in other words, you could borrow gold casino chips and at that price. Then we saw the second one come in. Now, why did that come in? It was no coincidence here. That came in just as gold powered into its all-time highs. Now, the previous delay in raising borrowing costs for this entire move up to around about 4,050, the reason for it, and we did drill down into it, was because the house, that is the LBMA CME cartel, who were wrong-footed naked short gold, and any margin increase along this way would have forced the cartel to buy back shorts into a bid-only setup. They needed time for enough speculators to get on board for them to actually rinse out. Now, you can imagine what was happening into these highs, because this is where the BIS had squared its last 4 tons. Bearing in mind, that was $409 higher than the forced September close. So essentially, August close. So the end of September was squared $409 higher. So with 30 tons still to short cover into what was really a $600 per ounce rally, something had to be done to avert a full-blown derivative gold default. Namely, not to stand in the way of the gold price rising, but only to the extent of how many speculators could be sucked in long with the house 1-to-1 short against them. The optimum point arrived last Monday, the 20th. Now, this was just when enough ballooning, naked long open interest had been sucked in. And again, with the house taking the short side, now already planning these 2 margin increases and a bid pulled event. And as soon as that was announced, in combination with, and bearing in mind, these market makers have a footprint in both the COMEX and London. We're looking at the COMEX market here, the derivative market, in combination with some bid pulling, and these specs having sucked in naked long, they pulled the plug on these massive leveraged positions. And where did we go to? A complete gap close. And this margin increase here had increased costs to borrow by $3,000 per contract to $20,000 to run that contract. As I say, this was enough. These speculators are leveraged using the prior profits to continue to leverage. So this was a classic rinse out. And given enough speculators had leveraged themselves long using paper profits to add more borrowed gold to the limit, this margin increase, along with strategically timed pit manager bid pulling, this borrowing cost to increase was designed to trigger a self-fulfilling waterfall spec long stop ignition. So the subsequent full circle retracement, basically, of the 3-week rally, and it was a 3-week rally all the way to this point here, around about the 5th. And this can be summed up quite simply. A full gap close flush with the speculators from the commencement of the October rally all getting rinsed out. And, as is always the case, momentums are always wrong at both ends of a move. And by definition, they don't like sideways action. So they were forced into a pillar-to-post rinse and immediately took the other side and bet naked short. So really, probably around about this level here, all the specs, the longs were pretty much rinsed. Then you've got a couple more come in. Then these were fully naked short sales. So where we had ballooning naked longs driving the price higher, we've now had ballooning naked shorts doing the exact inverse and reaching its limits. This is a classic bullish setup. Now, just for reference, I'm recording this on Wednesday, and this is Wednesday the 29th, really just between the AM and the PM fix. So obviously, don't expect, and we've got FOMC coming up, you're going to see some short-term two-way action, but really, as far as we're concerned, it's more attractive now to take out the short stops to the upside than to try and sell, naked short sell gold lower. This also applies to silver, but we'll look at that in a minute. Now, momentums will be the last to know that the house is stealthily taking the long side of these borrowed short bets. And as we will see, this bid-pulled overshoot of real money physical support levels, it now places these speculators into the crosshairs for an upside rinse of their short bets. It's a complete inverse view to them getting long. Now, true to form, these directional momentum specs, who control some 85% of all the COMEX gold and silver open interest, and oil as well, pretty much gold, silver, oil, all pretty much controlling about 85% of it. They've borrowed gold from the house on the short side now. And this looks to have been playing out into what looks like the conclusion of a capitulative rinse. Now, with the house increasingly exposed to upside T+1 delivery demand, forced delivery obligations that actually are being loaded out, the house has to be on the long side of these speculators. They don't have the liquidity to just keep adding paper shorts, because it just literally forces delivery. Now, into this entire two-way spec flush, it'll soon be revealed that as yet unseen central bank, sovereign and institutional buyers are quietly converting a rising dollar. A lot of this has happened into a rising dollar. What do you think they're doing? They're saying, yeah, while the automated spec sellers will say, hey, dollars rising, sell gold, dollars rising, sell silver. But what the real money is doing is saying, hey, we've got a rising dollar. Hey, what an opportunity to convert dollars into gold, into silver. So you're kind of sometimes seeing that correlation really breaking apart. So what this does is set up a competitive short stop rinse to the upside, setting up the next higher physically determined spec-free, I will add, speculator-free price to rally from before the next round of hot money sets itself up for a fresh long stop rinse again. Now, while this old school legacy market pushback is being orchestrated in sync with every media outfit calling gold a meme-like bubble, in reality, from a paper to physical perspective, we've been evidencing what is really a necessary and very constructive 96% leveraged long stop flush and an equally ballooning 96% spec naked short positioning. Now, the media has been likening this price smash to struggling to find some sort of parity to what's happened in the past, even though things have changed so rapidly. So they would likened it to the 3 year. They were talking about the 3 years ago, the 2013. Oh, yeah, there was a $600 sell-off from $1,600 to $1,000. Whereas in reality, the scope of this flush was 3 weeks. It's a 3-week gap close that's been limited to simply to how many naked long speculators holding open interests could be sucked in before just simply pulling the plug on the strategically timed COMEX-centric margin borrowing cost increase, which by no coincidence came in double whammy as gold was rising. Now, this planted, it's form-fitting. This kind of form-fitting mainstream media analysis illustrates that the mainstream media's lack of understanding of how dislocated the legacy gold and silver unallocated, unbacked, leverage price setting COMEX exchange has become versus the SGE, the Asian, the physical supply demand based price setting mechanisms that have evolved, and that very short term spec induced volatility aside, the COMEX is no longer in control of setting the global price of gold. Sure, short term. And we'll probably see more into FOMC today. Who knows? Doesn't matter. It's just really rinsing out all the froth. Now, what's missed by the majority of the legacy market analysts is that these are the people that pen pieces on Financial Times, and actually many of the newbie, what we call the newbie tourist gold experts that appear on Bloomberg, etc. They're just not used to talking about gold. So they haven't made the connection between the Bank of International Settlements reclassifying gold as a first-tier net stable funding ratio compliant asset class on the 1st of January 2023, as can be evidenced by the dwindling open interest, really, into the subsequent $2,500 rally, legacy rally, that real money open interest has exited the COMEX, exposing old school COMEX-driven price setting games. They're just no longer fit for purpose. Gold's risen over $2,500 since that point. Now, this very sticky real money has only just commenced gaining exposure to high-quality liquid asset physical gold outside the paper-dilated LBMA CME ring fence. Now, what's not being secured and physically removed from underpriced paper-diluted local London fixes is being secured in the very liquid Chinese SGE influenced Western-facing SGEI, international-facing physical exchanges. Now, we've been tracking this Beijing to US gold war since 2010, and it's significantly picked up since then. Now, this is gaining traction, big time. Gained traction after Russian assets were seized into an openly weaponized US dollar, and in the sanctions that relate to that. And the official de-dollarisation gauntlet Beijing literally threw down directly after Trump tariffs were threatened. So they literally openly said, right, okay, you want a fight, we'll have a fight. We've got the gold. And here are just 3 of these most recent takes. I just say, call them take the gloves off mandates to attract global gold buying and storage. US-sanctioned Russian asset seizures and tariff wars are evidencing China de-dollarizing, and most definitely this has Trump's attention. China aims to become custodian of foreign sovereign gold reserves to strengthen its standing in the global bullion market. Driven by Beijing's opening up direct convertibility to the yuan to gold and gold to the yuan FX structure, initial investors, financiers, hedgers, etc. operate in a smoothed out, true physically settled supply-demand price, and is a primary reason the dollar's share of global reserves on a balance sheet has surpassed US Treasuries. Now, this Financial Times assessment here illustrated that foreign central banks now hold more gold than the US Treasuries. However, given this official data fails to include thousands of tons of unreported monetary gold central bank buying, and with China alone securing a conservative 80,000 tons, and Russia, India, Saudi, and the BRICS another 30,000 tons, the percentage is far likely closer to 60% and rising. Now, in the meantime, Chinese and Indian gold and silver buying continues to compete with Western ETF demand. Gold is not rising, it's simply evidence that the dollar is being diluted with gold holding its purchasing power. It's that simple. So the de-dollarisation process is a natural event. And circling back to who and what was likely behind the official gold pushback against an out-of-control China-orchestrated BRICS plus dollar to gold de-dollarization escalation, i.e. just swapping dollars for gold, of the many ideas that have been trial ballooned, other than adopting the obvious choice of revaluing US Treasury gold to market to partly back the US dollar with gold, which will actually be enormously beneficial for the dollar, let's examine the various possible official White House to BRICS pushback options. Now, what could they be? There's really basically a couple. It could threaten to sell all its gold reserves. These things have been discussed. They could threaten to sell all their gold reserves in an attempt to devalue China's BRICS influence. Really? Given that deliberately unaudited US Treasury holdings are to an unknown degree rehypothecated with double ownership claims. So in order to sell its 8,100 tons of gold to effect this pushback, the US Treasury would have to first buy back billions of related underwater Office of the Comptroller bets, which would spike gold even higher. It's too late. The horse has bolted, and the US is left holding less than 1/10 of what the BRICS collectively hold. Less than. So US gold reserves are literally far too small to actually push back. And another reason, and this is another one which we've seen in the past. I think Saylor talked about it. We had various other people in the past pushing back and saying, hey, well, why don't we do this? Especially with the stablecoin mandates being pushed out. So the other idea, and this is what we're going to look at, is that because it's been trial ballooned more recently, that the US Treasury may try to back its 38 trillion of debt. And that's just official. It's much larger than that. But let's just say they want to back its 38 trillion of debt with freshly generated dollar-backed Treasury stablecoins. Now, however, and essentially what they're doing is that would attempt to devalue this 38 trillion of debt by forcing US Treasury debt on other global central banks. In other words, you got to use our stablecoin. However, this ignores the fact that the physically gold-backed yuan stablecoin is already one-to-one exchangeable for gold. And those being forced to receive these dollar stablecoins, trade with them, have the option of immediately squaring these debt-backed dollar stablecoins back into gold by way of instant settlement into BRICS, Russia, Chinese-led gold-backed stablecoins, thereby laying off this US dollar debt. I don't see it happening. I don't see it working. Now, this relentless BRICS gold demand has driven the legacy paper market to an impossible to maintain divergent inflection point that can only be resolved by one of two events. And we've looked at this. Either a massive bid only, T+1 margin call, spiking gold thousands of dollars higher, or far more equitably for the US, resolved by a more orderly US Treasury gold price revaluation. And of course, all the liquidity providers, all the smart people are saying, well, of course, they're going to choose that option. So, yeah, you can trial balloon all this other stuff, but there's the reality of it. Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside of the CME LBNA ring fence, the stealthy gold revaluation process that already commenced directly after the BIS revalued gold has gathered sufficient global momentum to force the US Treasury gold to be competitively revalued. Once it's revalued, the US will want a stronger gold price. And as we've been drawing attention to, every single non-dollar denominated fiat gold price, pound, yen, whatever, euro, whatever you want to look at, has been dragging lagging dollar gold price into its all-time highs. They've all been into all-time highs way before gold did. And yes, we will see from time to time the US is able to push back the dollar gold price from time to time, as we likely see again today into gamed FOMC volatility. But it's limited to how much COMEX derivative open interest can be laid off against a dwindling number of speculators siloed outside the real market price setters. They don't even know what that price is. And as we've been focusing on, the real game changer is that China took off the gloves the moment the yuan gold became fully Basel III compliant, and opening up Western-facing institutional grade one-to-one ability to one-to-one vault their bullion in vaulting facilities, which are able to eliminate unallocated gold counterparty risk. It creates a much more stable environment. Your gold is stored in physical environment. Now, this is what Trump is actually referring to when he accuses the BRICS of fighting a war on the dollar. We talked about that. He was saying they're fighting a war on the dollar and we're going to push back. And as we have just outlined, there is little doubt that the White House is looking for solutions. And as we just evidenced, net of what dwindling open interest that can from time to time be short-term flushed out, and these underpriced derivative discounts capitalized on by the SGE price smoothing flows of a physical environment, the COMEX derivative market has become a price taker. So net of this piffling volatility, so historical price manipulation is not a sustainable option. So if you've been a stacker, then obviously you've welcomed and embraced it alongside every central bank, every institutional buyer who have not stopped buying. Now, with some 100,000 tons of BRICS Alliance gold backing a sufficiently liquid global price setting mechanism, so that would be 80,000 of tons in Beijing hangs. Then you've got Russia, India, Saudi, and BRICS, a best estimate aggregate of 30 tons. So that, there's easily 100,000 tons there. As we have seen, and as we've just outlined, it leaves very few options for the US to push back. The current administration has inherited, and it must stick in their throat. They've inherited a comparatively insignificant and very compromised 8,100 tons of US Treasury holdings. Therefore, it leaves very few options to really bolster debt-riddled dollars from being depreciated by debt-free, first-tier, high-quality liquid asset gold. Very few. So in summary, China has accumulated sufficient physical bullion to price its debt-free gold currency, foreign exchange cross, against the debt-riddled dollar and US Treasuries to be able to retaliate against flip-flop uncertainty of US sanctions. The ability for central banks, sovereigns, and all categories of Western-facing global investors hedgers, producers, etc., to be able to treat gold as a high quality liquid asset on their balance sheet is driving the next wave of gold demand sufficient to discover a gold price that doubles current estimates. So there you have the LPMCL, you have the CME, you have the old cartel. Not even they're not even categorizing gold as this high quality liquid asset. Yet you'd only have to hop one small boundary, and there it is. So to explain this, while on the 1st of January 2023, Basel III gold was classified as a first-year asset, it was still technically not classified as a high-quality liquid asset, meaning collateral that could actually be pledged one-to-one and borrowed against. However, one-to-one yuan gold conversion changed all of that. Now, while I'm on the spot chart, just want to illustrate, this is where we opened up the quarter. And do you see any damage done? Don't see any damage done at all. And in fact, all our targets are still in place. This was the 3,800 level. One by one, these targets are getting hit. 3,800 for the 4,000 level. Now looking to still fulfill a 4,500 level. But just wanted as an aside. The point we're trying to make here is China has secured enough physical gold to be able to one-to-one pair its currency with physical gold. Now, the ability to enable seamless one-to-one instant conversion of the yuan to physical gold and or borrow against gold deposited in the expanding Western accessible SGE vaulting network instantly turns first-tier gold into a high-quality liquid asset. This is attracting global central banks and institutions to convert depreciating fiat dollars as measured in gold, spot gold, directly into risk-free, high-quality liquid asset gold and to use it for trade. It is this demand that is going to drive the gold price into our end-of-year 4,500 target and beyond in 2026. So let's sum up exactly what qualifies as a high-quality liquid asset. Now, traditionally, it's deemed to comprise of cash, government bonds, convertible securities, but all of these are debt-based assets that ultimately rely on trust, each holding an unknown degree of counterparty risk. Now, cash faces dollar debasement, potential sanction, bail-in risks, while debt-based treasuries and convertible securities are vulnerable to defaults and or possible daisy chain reactions. However, China has usurped gold, classifying it as the only liquid zero counterparty risk high-quality liquid asset. And that is why global central banks alongside sovereigns, Western-facing institutional investors and borrowers are being onboarded at unprecedented rate into SGE physical-backed exchanges. The CME LBA wonder why this liquidity is disappearing. And what does it involve? It involves selling dollars to buy gold. China has now gained full control of the physically settled gold price setting mechanism, and to accommodate Western-facing participants who are in the advanced stages, they're opening up the Western-facing global gold corridor. We can all access it. Investors can buy and pledge high-quality liquid asset gold in Hong Kong, in Singapore, and then you've got the SGE is opening up vaults in Zurich, Dubai, multiple cities in Africa, South America. I mean, it's done. They've usurped the entire gold market. So circling back to very short term, gold and silver are rapidly moving into strong hands with very large short stops layered above the market and naked long momentum specs rinsed and commercials one-to-one taking the long side of freshly retrenched naked shorts. You can see them active. They're trying to fight this rally. Momentums do not like sideways action. They want a direction, and they will be wrong at both ends. And once again, that's exactly where we are in this process. So I think what our liquidity providers are simply saying, look, this physically driven gold rally has simply paused mid-rally, with fresh 2026 targets being assessed as high as $8,000. Now, they're deliberately constructed a bearish head and shoulders structure, which is a classic bearish structure that technical traders may either try to create if you're a market maker or a cartel, and you've got control of the futures markets. But this head and shoulders pattern was really designed, or really will have emboldened momentums to go short. So we still may get the odd pullback here. And that's nothing, or the short-term overshoot of what is really very, very strong physical support. But this would require a lot of fresh naked short supply, and there is not enough open interest. In other words, COMEX chips for the COTs exposed, the commercials, exposed to T+1 delivery obligations to hedge against this purely synthetic structure. And we saw them attempt the same thing in silver. But again, for the same reasons, there isn't enough open interest, derivative open interest, against physical demand for them to be able to. This is no longer just a synthetic marketplace. The prices are being set outside of the COMEX. And just based on this alone, you only have to listen to mainstream media. You only have to listen to those with a vested interest for the gold price to go down. All the usual suspects are calling for a deeper correction. At best estimate, looking at the paper to physical structure, we figured the momentum-driven naked short overshoot may have had sufficient momentum to briefly breach the gold futures 39 level, which it didn't. It was only $1.50 above that. Bearing in mind that futures traders are, and those exposed to physical delivery, T+1 delivery, will be long gold futures to hedge any kind of breach of 3,900. And we figure by this point, even the most bearish projections will have been exceeded, and commercials will be actively hedging physical exposure, which is what we see at the moment. Again, this is Wednesday between the two fixes. Illustrating the gold sell-off has been spec momentum driven into a top to bottom 43.98 10% sell-off. ETFs have only contracted by 0.01%. That is, out of 5,295 tons of very sticky institutional ETF demand, ETF outflows have so far only contracted by 59.72 tons. That's, again, 0.01%. And these outflows are likely spec-related. In silver, the top at 53,765. Now, this is silver futures we're talking about. Now, spot was much higher. But anyway, in silver futures, that top at 53,765 into yesterday's, now we're recording this on Wednesday, so yesterday's 45,510 low, in other words, 45.51 low, that was actually a 15% rig sell-off versus an 18 million ounce to 1775.79 million ounce contraction, which is only 24.21 million ounces. That's just over 0.01% contraction in ETF open interest, with the bulk of these offtakes really to gain cheap exposure to silver.
Well, all right, Andrew. Now, when we say, live from the vault brings you information that you just can't get anywhere else, that's an amazing example of exactly what we're talking about. Now, as you know, in addition to our massive, gold community, we do have a sizable silver community, and they're asking one question, Andrew. What are you seeing in silver right now?
Yep, and that is the question I was waiting for, Shane. I know that it's close to your heart. Everyone knows you as the silver guy. So let's have a look. Let's going to record.
So let's take a look at spot silver. This is where silver opened up the month, the fourth quarter. Now, despite all of this gaming, what did we saw? We saw a very strong support at what is really, we've put this in there. This is relates directly to where liquidity providers talk about very, very large waiting interest. We saw an exact bounce on this, what we call a bull pivot. And then now this is where silver opened for the month. This is the extent of the pullback. And we're seeing short covering. Why? Because it's a physical marketplace. Now, there's little doubt that silver really came under the LPMCL's hammer. Clearly. And while this has short-term alleviated a very close shave default position, now that all the hot money as silver futures longs have been rinsed out, followed by these momentum traders now positioned naked short into very tight supply, these low-hanging short stops will become competitively attractive. And we can see them here. And we're now seeing a bunch of round numbers getting taken out. As I say, FOMC later, expect some gaming. But on Friday, we should have this resolved.
Now, while the LPMCL has been able to paper over the worst of its real paper physical shortages, and that's assisted somewhat in narrowing their deeply backwardated futures to spot basis spreads. Remember, we talked about them going as high as $3. And it's still backwardated, though, in the sense that even though if it's trading at par now, and it's pretty much at par, a little bit of a premium, but this should not be happening. It illustrates there's still a lack of supply versus demand. And while these same four LPMCL actors also have a footprint in the COMEX and the SGEI, the international facing SGEI, and they've raced to ship silver back into London to avert of default, that's why they raced it in. As soon as this bullion lands, it's competitively drained. Hence, it's not all you've papered over the problem, but you haven't papered over the physical problem. Liquidity providers are reporting, very in capitals, very strong SGE demand into mainland export controls. And while SGEI silver was shipped out by the LPMCL to capitalize on local London shortages, these shortages still exist. Now, the opportunity to convert this synthetic silver discount into bullion, this is really a very short-lived window. And with specs flushed into very tight supply, liquidity providers estimate silver will regain and test its all-time highs by the end of the year. And this time assisted by competitive short stop hunting with far too few rinsable specs to flush next time. It's really what we're seeing is really the inverse of the specs that have gone on board on the long side. Now there's very few of them, but there's plenty of shorts with short stops that are really attractive to come after. Well, look, if you're a stacker, and I know most of you are, this opportunity to convert depreciation debt-based fiat into physical gold and silver at these deeply underpriced pivot points, that's what we're witnessing here, will be seized on wholeheartedly. By the next episode, this short-term synthetic action will be in the rearview mirror. And all I will say is, good hunting, guys.
That wraps up another episode of Live from the Vault, brought to you by Kinesis Money. And a big thank you to Andrew Maguire for sharing his deep market knowledge, as you can see, and also to you for tuning in and being a part of this growing global community. Now, if you're new here, be sure to hit that subscribe button right now and tap on the bell if you want to be the first to know when we go live. And if you've been with us for a while, please help keep spreading the word and give us a like. Share this episode with someone who really needs to hear what Andrew has to say here about this precious metals industry. And Get your questions also into Andrew Maguire. You never know. Like I said, your question may well be selected for next week's episode of Live from the Vault. So, and with that, we'll be back next week with more truth that you won't find in the mainstream media. And until then, buy physical, make sure it's backed 1-to-1, and we'll see you right here on Live from the Vault next week. Bye for now.